Hello and welcome to my morning note. We've had a lot of drama in the last few days on world markets, quite a correction, but the broader picture for this year remains in place. This has been quite a rally, and what's most remarkable about that rally is that it is, to use the words of my guest today, a profitless rally, a profitless recovery. Earnings per share have been flat for well over a year, even as global equities have rallied more than 30%. How can we explain this? With me now to discuss it all is Citigroup's Chief Global Equity Strategist, Rob Buckland. Let's start by taking a look at a chart which you prepared, showing that earnings per share basically since the markets had its recent low in 2011 has been utterly flat globally. What is driving this, and what is the importance of dividends per share in this?
Well, you can see flat earnings, middling dividends, the green line,
yeah.
And then at the top, the stock market up 30%. That's the one we've got to get right.
Yes.
We think there's a couple of things going on here. First of all, markets just got too cheap back in 2011. They got down to a multiple of 12 times compared to a long run average of 16.
Which was after the US downgrade scare.
Absolutely,
right?
yeah, in 2011, and nasty euro concerns as well. And I think basically that's a key driver of what's been going on. The other thing is just other asset classes have got very low yields, and I think that's attracting capital towards equities.
Okay, so we've had, by your calculation, the biggest re-rating in the middle of the cycle, as opposed to, say, in March 09, which was the beginning of the cycle. The biggest re-rating, the biggest increase in PEs in some 4 decades. Is there really a justification for that? A number like that screams that we should be careful, doesn't it?
Sure, absolutely. And I think it's important to remember we got one of the biggest mid-cycle D-ratings beforehand in 2011. You saw a 25% correction in share prices in 2011. I think markets were worried about a double dip, a follow-on from 2008. When that didn't really materialise, flat earnings have been enough to allow the market to mean revert in valuation terms from, as I said, 12 times up to 16 times.
Now, one of the more interesting points you made is that dividends, the actual cash that people receive, perhaps matter more than earnings in the current environment. Let's take a look at another chart that you prepared. Take us through how you derived these numbers, which suggest that there's still strong returns to come from here, judging by dividend yields. Right.
Your entry price dictates your 10-year return with a 75 to 85% probability. So that's pretty good. That's very good in very risky and difficult markets. And what this chart here shows you is what was the market from a dividend yield perspective predicting in returns across these various regions back in 2011 at the low you were mentioning, John, but also where are we now? And what you can see is that the markets were predicting globally somewhere around 8, 9, 10% annualized returns for the next 10 years at that low back in 2011.
Many of us would happily accept.
Yeah, absolutely. Yes. And of course, the strong rally means that those have eroded, future returns have eroded down to maybe 6, 7, 8. Now remember, if the global dividend yield's about 3, okay, that's really only saying you're going to get 3% capital gains per year over the next 10 years, which is not spectacular, but it's a lot better than getting 2% in bonds.
Now, one thing that is intriguing from this is that the US shows up, which has obviously been leading many markets, certainly leading developed markets.
Sure.
Looks the least exciting market coming into this, and continues to look the least exciting now. Does that imply that there's something a little concerning about the continued leadership of the US and Japan?
Well, the US is a good story, Japan is a good story. But of course, what good stories do is they attract capital towards asset classes, and they start eroding the attractions of that story. So that's exactly what this chart here shows you, is that the US has been doing that on a 2-year basis. Japan, as you know, John, has been doing most of this return here over the last 6 months.
Finally, just to make sure I understand, what you're talking about here isn't about the bursting of a bubble, but you are talking about lower positive returns from here on, right?
Absolutely. What our indicators are telling us is that markets have moved from being cheap to fair value.
Okay, Rob, thank you very much indeed. I think there are 2 key takeaways from that. First of all, in an environment where bond yields are so low, dividend yields become more important and can keep stocks higher than you would otherwise think for longer. And secondly, despite the appearances from that extremely ugly sell-off in Japan, there is no particular reason to fear an imminent crash just at the moment. There are reasons to think that returns are going to be very much more mediocre in future than we have been used to of late.